The private credit market in India is small but growing. Last year, there were more than 163 private credit deals in India, valued at 9.2 billion, compared to 8.6 billion in 2023 and 5.9 billion in 2022. The assets under management of private credit in India is expected to reach 60 billion by 2028, constituting about a fourth of the total AUM of the AIF industry. Currently, there are more than 20 private credit AIF players in India. I caught up with Vineet Sukumar, the founder and MD of Vivriti Capital, to understand more about private credit and its growth in India. Vivriti Asset Management, established in 2019, is a SEBI-registered asset manager investing in debt issued by mid-sized enterprises. The firm has invested over 7,500 crores across its strategies in more than 90 firms, counts over 1,000 unique LPs, and has returned more than 1,800 crore to clients to date. It is part of the Vivriti Group, which manages a portfolio of more than rupees 11,000 crores. Over to Vineet now. Vineet, how do you see the change in the private credit segment over the last 2 years?
Firstly, thanks for having me on this podcast. The private credit ecosystem has undergone some radical shifts in the last 2 years. The first trigger for this was March 2023, when the budget changed the rules around taxation. And what I mean by that is that credit as an asset class earns interest as income predominantly. Capital gains is quite low. And the taxation for that is the full income tax of the individual. For a long time, debt mutual funds had an advantage because the income tax on a debt mutual fund's returns was considered lower than for interest-based taxation. The budget of 2023 leveled the playing field, and that made a very large investment ecosystem sit up and say that if that benefit goes away, should they allocate more by keeping tax in mind, or should they allocate much more keeping the gross fund returns in mind? And the balance shifted towards the latter, right? Since then, the industry has seen a pretty fantastic growth. While I do not have numbers on the fingertips, but I believe that the number of players has actually tripled in the space. Serious players with capital, with teams, and with products that can appeal to the large investment population. Secondly, the number of folios or unique investors also, I believe, has at least tripled in this period of time. And thirdly, I believe that now we are on a path which will be a long-term sustainable path, right? Now, for context, India issued alternate investment fund guidelines in 2012, and probably the first credit fund came up in 2014. Between 2014 to 2023, the number of players in the industry can be counted on the fingers of two hands, right? Serious players. After 2023 till circa March 2025, that has really taken off in various ways across the country. So yes, I'm much more encouraged about the future of the credit industry today than I was 2 years or 3 years back. We always saw it as a very large macro play. As at a macro level, all parts of the corporate ecosystem need private credit because that's a good flexible financing tool available. But it wasn't happening for various reasons. Now the macro and the micro have kind of aligned, stars have aligned, so to speak, and we see this now as a growth path that should continue for a very long time.
How have your AUM grown, and where are the opportunities you are seeing?
So, Vivriti Asset Management's AUM in this period of time has grown by around 2.5 times, right? By the end of this fiscal, we should be managing approximately 3,800 to 4,000 crores of assets. And that has grown very well over this last 2-year period. It's also been a very satisfying growth because it's not come by appealing to one or two large pools of capital who backed us. It's extremely distributed. Today, Vivriti Asset Management raises probably $2 million a week from a very distributed base of LPs that cut across not just the 4 large metros, but more than 40 more cities across the country, right? Backed by HNIs, backed by regional distributors, backed by independent financial advisors, family offices, in addition to large institutional pools of capital like insurance, banks, and developmental financial institutions, right? So it's been a very satisfying growth because it's so distributed across the country. What's also been satisfying is the investment capability we have built on top of this, right? Private credit fund management is fundamentally different from mainstream mutual funds in a sense that large mutual funds are playing an interest rate game. They are not looking over their shoulder or waking up in the night worried about default risk. Why? Because fundamentally mutual funds invest in AA, AAA, and Government of India bonds. And that's not an area where you expect defaults to happen. Yes, you can lose valuation because a company performs not so well, and bond yields can rise, prices can fall. Those things can happen, but you're not constantly worried about default risk in the portfolio. The private credit fund manager is always concerned about default risk, is always concerned about whether the companies that have been added to the portfolio will continue to pay the next coupon, will continue to pay capital back on time, and should they be thinking about exits at an earlier stage, what is the event risk that the portfolio is taking, what is the EBITDA and growth risk that the portfolio is taking, etc., etc. So it is a fundamentally different competency. And building this competency has taken us time as well. But today we have financed nearly 100 corporates and financial institutions. Today we have had more than 70 exits in the portfolio, and we continue to run a fairly blemish-free track record as we speak, and that's been a very difficult competency to build.
So on that, so are you saying that you don't have any NPAs at all, or how do you assess the total credit risk? Do you go by the rating agencies?
Answer is no. We don't really go by rating agency information. Yes, it's a good hint. It's a good indication. If I use rating agency data, then Vivriti Asset Management's portfolio has seen a 3:1 upgrade to downgrade ratio. That's a pretty good number. The large corporate bond market or the mid market has seen roughly a 1.5:1 ratio. We are at 3:1, so we are well ahead of the market. It's a good sign, but it's not the only sign. A better sign is that in an amortizing portfolio, have payments been made on time? Answer is 99% yes. You asked me if we have any non-performing assets. We do not have any non-performing assets on the portfolio. The third indicator is that and that's more internal to us, are the investments or the investee companies that we have, are they tracking the thesis? For example, have they grown as planned? Have they continued to stay true to their business model? Have they met milestones of EBITDA, of revenue, of scale, of capitalization, etc.? Have they won contracts, right? And I think there we are quite happy with the portfolio that we are running. We run a portfolio that cuts across 20 sectors, and therefore we need to track at a very granular level how each portfolio company is performing basis the metrics we've set out. With each company, we create a 3 to 5 year business plan working with the promoter and management to agree on a path. And that's what we need to track in terms of outcomes and milestones. And I think we are quite happy with where we stand right now.
So mostly your target is the SMEs, right? Is that it?
India has fairly strict definitions of SMEs, and therefore most of our portfolio companies do not fall in the definition. What I mean by that is that the Indian definition of SME is micro, small, and medium, and the highest category is medium, which means a top line of 500 crores and below, right? We probably start at 250 crore of top line, but the largest company that we have financed has gone north of 3,000 crores, right? So it's not SME in the classic SME definition used by the government and the ministry, right? Yeah. It's more mid-corporate, right? So from SME to mid-corporate to large corporate is how we look at the corporate ecosystem. Large corporates are the ones that find their place in a mutual fund fact sheets, not in our fact sheet. Mid corporates is a space where we are, where most of our portfolio companies belong to.
The private equity area, they are finding it hard to raise funds from investors because investors are now being more stringent about returns, and the kind of investments that are made. Do you see some kind of that scenario playing around in private credit? Is it easy to raise funds from investors?
I agree with you on private equity, and I would actually extend that to all private markets. It is a given that when public markets do extremely well, private markets struggle, right? So the entire private market space, be it equity or credit, in the last 18 months has had to contend with the fact that public equity markets in India have done exceedingly well. And therefore, most allocators, family offices, institutional investors have preferred to allocate to equity, right? And so in general, fundraising for private markets has been good, but not phenomenal, right? Private credit has an additional problem. In private equity, usually the interest rate differential between two economies or the depreciation of the currency plays a role, but not a very significant role. India can offer very good equity returns on private equity as well, and therefore global allocators are quite happy to allocate to India. In the credit market, however, relative value makes a huge difference. If we take a classic private credit deal in India and we swap it back to dollars, right, you will have to contend with currency depreciation. You will have to contend with tax leakage that happens between India and an overseas economy. And the combination of the two takes away a lot. It takes away anywhere between 500 to 600 basis points from the gross yield that the product is offering. And then it may look unattractive relative to what US markets are delivering on credit. So for the last 3-4 years, this relative value problem between US and India has been quite stark, and therefore private credit has faced an additional challenge when it comes to raising international capital. So international capital raise in private credit has been very, very low in the last 3-4 years on account of this relative value problem.
Do you see that changing in the near term, long term, medium?
Yes, I do. I think it's quite interesting to see what's happening in the US with the Trump administration seeking to have a weaker dollar, right? And that's not something we have heard from the US at all for years, right? So I think like many market participants, even we see this as completely uncharted territory. And if the US seeks to have a weaker dollar, which implies a stronger rupee, and that cuts down depreciation of currencies, then the relative value problem can be significantly solved for. And that can make Indian credit attractive to international markets, right? But let's see, these are completely uncharted waters.
So Blackstone has been saying for a long time, that they would like to enter the space. And earlier, the CEO was here, and they are talking about a fund, which they will, they will invest over here. How do you see that imminent entry of them into this space, and will it change the whole thing, dynamics of the sector?
I think the market is too large to be swayed by one single player. We would very much welcome the entry of some of the global giants into India, because I think that will result in a lot of India credit history being made available to global markets to track. So India faces a slightly peculiar problem, which is very technical. India as a country is rated BBB minus on the S&P scale, right? And similarly for Fitch and Moody's. There's a certain implication in terms of default risk. If you, however, track 20-year history of Indian corporate defaults, the outcome is much lesser than what you would assume from a BBB minus letter. So therefore, when someone like us, seeks to raise international capital, and we go out and present our data and say that, this portfolio seems to look like an A risk and not a BBB risk, right? But the other side is saying, unfortunately, you guys are rated BBB minus, so I cannot take whatever you say and use that for my investment philosophy, right? So it creates a slightly tricky problem, especially for investors who are caught by regulatory capital. An insurance company, for example, is caught by regulatory capital, and the letter of rating matters. Now, what is the solution for this? The solution for this is if more and more India-focused players internationally start investing, experience a cycle of investing and returns, like what they see, and are able to represent to their LPs and others that it's actually a gold mine, right? And India's sovereign rating should not have a role to play in how you think about investing in the Indian market, right? So, what does it mean for us at Vivriti? We are always on the lookout for very large pools of capital for whom India is important, right? So India is important for a Blackstone because they would have an allocation out of DM, developed markets, into EM, within EM for Asia, within Asia for India. And if India continues to outpace the rest of the world in terms of GDP growth, it will become more and more and more and more an irresistible destination for many players, right? Now it is that wallet that we have to capture, right? And educate and bring them up to speed and get them to experience a cycle so that they can then go back and be ambassadors along with us to bring more and more pools of capital into India.
All right. Thank you so much. Thank you so much for the insights that you have provided. Thank you very much, Vineet.